Okay, guys, in this video, we're going to cover RSUs, or restricted stock units. Now, these are a type of equity that is just granted to the employee as a form of compensation. You do not need to purchase them or anything like that. It is just the full value of the stock becomes compensation to you. Okay, so they are fully grants. Now, they usually vest over a number of years. It's outlined in the agreement that you sign when they offer you, the equity grants. They usually vest 4 years is very common. So for example, you might get a grant and it's 10,000 shares that vest annually over 4 years in equal portions. So in other words, on the grant date, you'll get 2,500 shares. The next year on the same date, you'll get 2,500, 2,500, 2,500. At the end of year 4, then you've fully vested all 10,000 shares. They might do it differently. They might do it quarterly. They could do it monthly. There's a lot of different ways. So you just got to check the timetable, the vesting schedule is what it's called. So some RSUs also have a double trigger for vesting. Okay, some companies can set it up this way. That means not only do you have to actually hit the vesting schedule, right? Hit those dates and get those number of shares, but you have to meet a second trigger, which is a liquidity event for the company, whether an acquisition or an initial public offering, like they go public. And so even if you vest all of your shares, they may not truly be yours because you're waiting on a second trigger, which is a liquidity event. So once the company gets acquired or IPOs, then all of your shares vest at once, or all of the vested ones anyways. You might have other ones that haven't vested yet, in which case those ones would then fully vest on their vest date, okay? So that's something to keep in mind with how the vesting schedule works. Now, once these shares vest, and in a private company, right, you can't necessarily sell your shares, right? They're not publicly listed. So typically you're going to hold on to these shares until the company has a liquidation event, right? But they are yours. You can leave if it's just a normal vesting schedule and you vest the shares and then you leave, they are still yours. You still own the shares and you'll still cash in once that company has a liquidity event, that you qualify for. So once they're vested though, then the fair market value of the stock at the time of vest, based on the valuation of the company, every company gets a valuation done. They have these types of options typically once per year. They value the business and then divide that out by the number of shares and everything like that. So whatever on your vest date, whatever the fair market value of the stock is, that is compensation to you. So if you vested 1,000 shares and the stock price is $10, then the total value is $10,000. Okay, that is your grant. That $10,000 is taxable income to you in that calendar year. So the fair market value of the stock times the number of shares that vest in that calendar year, that is taxable to you. Unless, again, there's the double trigger. Then they're not quite taxable yet. You wait for the second trigger. But commonly, there's no double trigger. You just got to check your own plan with your employer. But once vested, then they are taxed as ordinary income. There's no preferential tax treatment, just ordinary income. All right. Now that price, the fair market value at the time of vesting, becomes your cost basis in the stock. So in the future, let's say you fast forward a few years, that same stock that was worth $10 when you vested, right? Let's say in a few years, there's an IPO and the stock is trading on the stock market at $20 a share. Your cost basis is $10. The fair market value of the share is $20. If you sell, then you have a $10 gain. And if you've held it for longer than a year from the date that you vested it, then you're charged only long-term capital gain tax, which is commonly 15%. It could be up to 20% based on your income. Let's say fast forward a couple of years at IPOs, but now the stock is trading at $5 a share. Okay, you have a capital loss of $5, right? Because you bought it at 10, it's now 5. It's a $5 loss. If you've held it for longer than a year, then that's long-term capital loss, and it can be that goes against and kind of offsets long-term capital gains and other taxes you might owe. If you've held any of these for less than a year and the stock has gone up or down, then it would be a short-term capital gain or loss, in which case a short-term capital gain is taxed at regular income tax rates. So if you're in the 24% tax bracket, then that is what your tax will probably be. If you sell at a short-term loss, then that is deducted against your taxes owed for the year, okay? We'll talk all about short-term and long-term capital gains in the tax module, but that's how restricted stock units work, okay? So they are taxed. Now, if your company is publicly traded and you are receiving restricted stock units, or for example, let's say you have restricted stock units and the company IPOs, well, what will happen is they will sell because you owe taxes on it, right? You owe taxes on that. They are going to typically take a portion of the shares, sell them, and send it to the IRS as tax withholding. Because instead of cash, when you receive cash compensation, right, they withhold taxes out of that, out of your paycheck, but you actually have money to pay for it, right? When you receive equity grants and it vests and it's taxable, you own stock. You can't pay taxes with stock, okay? You have to pay with cash. And so they will, based on your withholding on your W-4, they will sell a number of stocks, calculate the withholding, sell the stocks, and send that money to the IRS to withhold taxes in advance for your upcoming tax liability. At that point, if you decided to sell your shares, your RSUs, then you could, right? If you sold on the day that it vested and it's a publicly traded company, you could sell it and there would be no additional tax implications, right? Because that's your cost basis. The date of vest, that the value of the stock then is your cost basis. So you're being charged income tax on the whole bunch, no short or long-term capital gains, if you sell right then at the same price. Okay. All right. That covers restricted stock units, RSUs. We're going to cover incentive stock options in the next video.
Simple concepts, smarter choices.